Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. With stocks back near all-time highs, capital is gushing into the U.S. financial markets, and investors are feeling exuberant again. So, is all this bullish optimism justified? Today's guest, Chance Finucane, Chief Investment Officer of high net worth advisory firm Oxbow Advisors, takes a more cautious approach. In their recent market letter to their high net worth clients, Chance, along with Oxbow founder Ted Oakley, delivered the warning that, quote, it's a different time now, a time when the chickens may come home to roost after a period of distortion that has artificially and unsustainably goosed financial asset prices. Chance, thanks so much for joining us today.
Yeah, great to be back on, Adam.
Great to have you back on, Chance. You're looking way too rested for a young father, but hopefully that just means your son's a good sleeper and your spouse is helping you shoulder the load.
Yeah, no, all good at home, and crazy time to be trying to keep up with these markets too.
It is. Okay, so I did reference the piece that you and Ted recently put out. In fact, it's a piece I just sent to the premium subscribers of Thoughtful Money's newsletter or Thoughtful Money Substack for the Macro Pass service. But before we get to that, I just want to thank your colleague there, Ted Oakley. We did a webinar a few weeks back on his book, Second Generation Wealth. So essentially how to raise, financially savvy, financially resilient kids. The feedback to that was just off the charts. And I know that you guys at Oxbow have sent out, I think, thousands of free books to folks who have wanted to, read Ted's latest book on that topic and benefit from its main points. So, anyways, so fun to do, so well received. I hope we get to do more of that in the future.
Yeah, I know he really enjoyed doing it, and this is just me personally saying I think it's one of the best books he's ever written, and really liked the message that he was getting through on that one.
All right. Well, folks, look, if you want to get your hands on that, I will tell you at the end of this video where to go. But right now, let's dive into your latest report there, Chance. Like I said, you guys titled it, It's a Different Time Now. And why don't we just walk through it? I'll ask questions about some of its major points. So the first one was, sort of comparing the returns of stocks and bonds year to date. And I mean, the market feels like it's just on fire right now, and it is, I suppose. But our memories are short. Just 2.5 months ago, it felt like everything was horrible, coming out of the tariff. What was it called? Liberation Day tariffs. And so, if you look at the total return of the S&P and the Nasdaq in the first half of this year, they were like around 5%. Right? Which is really not that different with what bonds have returned, right? So, you could have started the year and said, all right, look, I'm going to go long, and you would have had a really stressful ride. Or you could have just jumped into the safety of treasuries and pretty much had the same return, but been able to sleep at night. So, while, again, right now, the animal spirits are running fast and hard. What are your guys' thoughts on the performance of the year to date? And, can these animal spirits keep running like this, or have they moved so far so fast that you guys expect some sort of pullback?
A pullback wouldn't surprise us, just given how far this rally has gone in the past 3 months. But I think your point is absolutely right that you're taking away that if you look across asset classes, whether it's bonds or stocks, and even the best performing asset class would be sort of like your gold and gold miners. But you've been getting pretty equivalent returns, and you're taking a lot of extra risk if you're trying to jump 100% into stocks at the start of this year. And if you're trying to do it right now, we think you're paying a very premium price that assumes everything's going to go smoothly. That's one potential outcome, but we think everyone's shifted to one side of the risk versus reward spectrum. And that's just not an approach that we think is prudent. We would rather have more balance, be considering what other scenarios could play out. And when you look at where things are priced today, we've got a group of about 400 high quality companies that we track. And this is about as overpriced collectively as they've been since we've been tracking this in years. And that just tells us that we want to really be prudent about what we're picking to own in our portfolios on the equity side. And even in other asset classes, we want to be very sure about the potential downside when you've got a 4% risk-free short-term treasury that you can always fall back to. And it's been a perfectly good place to be so far this year.
Okay, so I want to get to the question, maybe I'll even just ask it right now, which is the markets have been overpriced for a good while now by metrics of like, you know, Case-Shiller PE ratios, the Buffett indicator, stuff like that. Like they've been at historic extremes, but they've been at historic extremes for a good long while. So to the folks who say, all right, Chance, yeah, I understand that they're historically stretched, but what means they're going to correct anytime soon, right? I mean, shouldn't we just enjoy the party while it's going on? And some people are sort of saying this goes back to the old, permanently high plateau back from the right before the 29 crash. But hey, it's different. We've got technology, AI, et cetera, changing the way the economy works. And maybe these higher multiples are just the new normal going forward. So what's your guys' opinion on that?
Yeah, those sorts of very long run valuation indicators like the Schiller, the cyclically adjusted PE ratio, the CAPE ratio,
Mhm.
Buffett's indicator that everyone latches onto. I think you got to look a little bit shorter term than the last 100 years, just because, as you point out, the composition of companies to choose from is higher quality today, higher profit margin. And even though if you look at the last 20 years or so, or the last 10 years, there's still been this expansion to an extreme level. And one way to point that out is if you just look at the return of the S&P 500 of the last 10 years, it's really not that different from the last 40 years if you look at the growth in free cash flow or dividends. That dividend yield plus the growth in free cash flow is about 9 or 10% a year over the last decade, no different than it's been the previous 40 years. The difference is a third of the growth in the S&P 500 the last 10 years is coming from multiple expansion. And that's about almost like 4.5 points of that 14% return has come from valuations moving to a higher multiple. That's not going to repeat itself. So I think it's important to look at that and say it doesn't mean that things have to fall apart over the next 6 or 12 months. It's possible, but we're not really banking on that outcome. It's more when you look out 10 years, there's going to be a point in the next 10 years that you see a break back to more normal multiples, and we don't want to be fully in high beta stocks, things that could move in a big manner ahead of that, when we think it's safer to be in a more balanced portfolio until something like that occurs, and then you can get more aggressive.
Okay, so that's an interesting contrast to some of the other data you have in the report here, which sort of shows that the average investor is more all-in stocks than they've really ever been in many cases. So we've got record household ownership of stocks percentage-wise. Really scary is that just about everybody is all in. So even the folks that really should be in a much more balanced portfolio given their life stage, if we look at 401k balances, we see that investors aged 50 to 80, right? I mean, the oldest folks cohort there, they've got the greatest exposure to stocks of all groups. Now, they own the most stocks, right? Wealth is generally tightly correlated with age, but they are redlining stocks as a percentage of their portfolio at a time in life where they really should be much more in sort of fixed income, safer, less lower beta instruments. So is this sort of setting off warning bells for you guys that the system is just too exposed to hiccups from here in the market?
We would say so. And I think what happened is the returns since 2009 have been so incredible for stocks that maybe people were rebalancing, but at some point, maybe they just stopped rebalancing because you could just count on things continuing to do this well. But this isn't sustainable to continue to grow at a 13, 14, 15% annual rate in the stock portion of your portfolio in perpetuity. At some point, things have to return to more relying on the fundamental growth of the businesses that you do own. And then valuation will probably compress back to more of a normal level. You could pick out whatever you consider to be a normal price to earnings ratio for the market, whether it's 15 to 18 times. We're well above that. So I would say that it's the right thing to be rebalancing out of some of those gains you have in stocks and we're back to a normal bond environment, which was something we didn't have in the 2010s, where you were stuck with 0% short-term rates. Now you can get 4%, give or take, at a risk-free level. That's a good place to go to be able to offset things.
Okay, so rebalancing, that's actually an interesting question here. And one other stat I forgot to mention in kind of how everybody's in is it's not just the US investor, it's the international investors are also all in US stocks, right? So we've got, what is it? I think the MSCI index is, which is basically a snapshot of ownership of global equities, is about 64% in the US, so almost two-thirds. Yet the US only makes up about a quarter of world GDP. So US stocks are definitely over-owned versus their income contribution to the world economy. Okay, so again, another side of sort of extreme piling into US stocks. To your point about rebalancing, though, I believe right before we turned the camera on, Chance, you mentioned that you had watched a couple of recent Thoughtful Money videos, one being the one with Mike Green. Mike Green, very well known amongst this audience for really focusing on passive capital flows. And that is a core driver of why stock prices have just been powering higher since 2009, right? You just have this dependable, unstoppable buying of stocks every month as corporations have to deploy their allocations for their employees' retirement funds, right? So Mike has I've talked with him a lot about what are things that could create issues with those capital flows. And one is well, we could have a really bad recession, right? In other words, enough people could lose their jobs that those passive capital flows get reduced because there's just fewer employees to buy assets for. And that would basically cause those passive capital flows to start contracting, and we'd see a reverse scenario play out where instead of pushing stocks higher, they're going to start pulling stocks lower. But you're raising an interesting question in my mind, which is, what if it's not a recession? What if it's just rebalancing? What if people just start saying, you know what, I'm a senior citizen. I'm realizing I've got way too much in the stock market. Maybe the stock market starts to wobble a little bit and they get a little spooked and say, you know what, I probably should have a much greater exposure to bonds. And they just start moving capital in their retirement accounts from stocks to bonds. That would likely still have the same effect on the stock market, right?
Yeah, if you saw enough people, especially people hitting really the late stages of their life, and you all of a sudden look down and see just how much money you've accumulated, and you really don't need to take any more risk. And then probably the last piece that would cause that, and we've seen hiccups in the stock market when you see the 10-year treasury yield reach that. People have different numbers, whether it's 4.7, 4.8, 5%. You never know exactly what that triggering yield will be. But once people see a high enough treasury yield that they could lock in and say, I think there is something to a 5% yield, that some say, oh, I can get free 5% and I don't have to worry about this for the next decade. That might be a number that triggers people to move out of stocks and into something else. So it's hard to predict what the exact point would be, but there could be a number of reasons why people just realize they don't need to have that much in volatility in volatile stocks and move something to a little bit more clean space to be in the financial area.
Okay, so that is interesting because if you are a fan of math and market trends, there is the concept of reversion to the mean, right? So if we have everybody owning an extreme percentage of stocks, that concept would say, well, at some point it's going to mean revert, right? What actually drives mean reversion? Totally debatable. Nobody knows for sure. But my guess is that you guys probably do have that concern. Don't let me put words in your mouth, but that ownership will mean revert, especially as to your point, if bond yields continue to march higher from here. You begin to get worried that these higher bond yields are signaling that there's some trouble in the economy that might actually impact stocks. But you're also just saying, hey, that's actually a really tasty, safe yield versus what I might get going forward in stocks, and that rebalancing of retirement assets might happen anyways.
Absolutely. If you look at the last 60 years of the stock market in the US, it tends to move in these 10 to 20-year cycles where there'll be a 10 or 15-year long period where stocks are pretty much stagnant. You're not really getting much of a return. And if you do have a bear market, it tends to stay down at that lower level a little bit longer. And that time element and the magnitude of the decline tends to be something that turns people off of stocks. And it'd be hard for some people to believe that there were magazine covers in 1982 declaring the death of equities, but after 14 years of getting no return from your stock portfolio, people were thinking that way.
Yeah.
And then you had the period from 2000 to 2013 where you got nothing on your return, which is hard to fathom since it was so relatively recent. But we're in the middle of a 16-year-long stretch where stocks are going straight up. That's not going to continue forever. You just don't know when the next cycle may start, that we're going through a bit more of a up and down range type period rather than this secular up move.
Yeah, and at the same time, it may be correlated with a real secular change in the bond market, which I think, there's a fair amount of people out there that think that we have that bond yields bottomed a few years back, end of 2021, and that the 40-year bond market is over, and that we're going to have just secularly higher bond yields ahead from here. And what's interesting is, again, going back to the piece that you and Ted published, you have been looking at trends in the debt and the deficit, right, which obviously have exploded over the past 20 years. And as a result, I think you posit, and you're not the only ones positing this, that interest and attractiveness of U.S. debt is a little less than it used to be, right? And so we're seeing foreign central banks, they're cooling their purchasing of U.S. Treasuries. I've had a lot of guests talk about that. Similarly, we've seen world central banks buying gold as a real substitute for treasuries. So, that's showing a bit of a loss of faith in the U.S. debt market. So, the question is sort of like this may, those trends I just mentioned will probably keep, if they continue, will probably keep bond yields where they are or higher, which again, to our earlier point, provides this other attractive alternative to sitting in riskier stocks, or at least stocks that are stretched at these valuations.
We would agree, and there's a couple of points to that. So on the fixed income side, if yields do stay at this somewhat more elevated level compared to last decade, that's a good starting point to a balanced portfolio, and you could end up seeing yields drift higher. It's a difficult game, and we've talked about this before, trying to play the long-term treasury end of the curve. If yields are rising, it's tough to get a good consistent return on that. And it's difficult to trade it too if you think there's going to be a quick drop in yields that you could try to profit from. But on the short end, the short term, 2 years or less, you can get a decent yield. And then you referenced the point about gold, especially since 2022. We noticed the difference when Russia invaded Ukraine and you saw the sanctions placed on Russia. I think that made countries around the world take note that they need to have a little bit more control over where their reserves are placed with their central banks, diversify out what type of things they own as reserves. And you've seen a structural purchase of gold from these central banks for 3 or 4 straight years now that we would expect to continue. So that's been a long-term position for us, is gold and silver and miners that we think are high quality that play into that. And it's something that we'll adjust a bit here and there, but we don't want to get too cute with it because we think it's a trend that can play out for the rest of the decade.
Okay, sorry, the trend of central banks buying gold as a substitute for treasuries and seeing prices of gold and silver, continue to march higher from here. Okay.
Yeah.
You're nodding as I'm saying this. All right. So back to bonds for a second. So you guys do give a little bit of discussion in your letter to, hey, given how stretched you see the stock market, if we saw either some weakness in the stock market, or maybe more likely some weakness in the economy, that treasuries could get a safety trade here, and so we could see yields march back down. But you guys think that will probably be relatively short-lived, and that the more dominant trend over the next decade plus is elevated bond yields. Did I capture that correctly?
That's correct. So even during periods of higher inflation, like in the 1970s or 1980s, if there was a recession scare or a blip in the market that people were selling out of riskier assets, you still saw a drop in U.S. Treasury yields that moved to safety. So even if we're back to an environment kind of like that period in the 1970s where yields are drifting higher over time, any sort of concern about riskier asset classes or the health of the economy, we would expect yields to drop as people move into treasuries for a short period. But then that would only last as long as people were worried about the economy and their portfolios. Once things go back to risk on, we would expect yields to move back up and continuing to potentially trickle higher.
Okay. So at Oxbow, then, you guys manage a couple billion in assets under management for your clients. Most of your clients are high net worth families. How are you positioned for this on the bond side? I know in the past when we've talked, you've been, largely positioned on the short end of the curve, because you can get these high yields with good, really good safety. Um, how actively are you trying to capture any of the potential, near term or short-lived rush to safety and then bonds recovering? Are you planning on actively trading that, or are you saying, look, we're just going to play for the long-term trend we see ahead?
We tried trading the long end of the treasury over the last couple of years, and we didn't get the results we wanted. We weren't making any money on it. It's very difficult to time. And so from our perspective, I think on most things, we want to be thinking out multiple years, longer term through an economic cycle. And so rather than trying to catch a 6 or 12 month move in the bond market, we'd rather just lock in those 2 years or less maturities, either in the US Treasury or some high quality municipal bonds. That's where we've been focused in our conservative fixed income strategy, along with always having a little bit of an allocation to gold as an additional offset and a way to try to protect purchasing power.
Okay. So, there's a lot of talk right now about how many parties, especially the new administration, the Trump administration, thinks that the Fed should be cutting rates, right? And Chair Powell has been resisting to date, but it does look like the market is increasingly expecting that he will start cutting again at some point this year and then into next. Uh, Assume for a moment he does, and the short end of the curve starts, yields on the short end start coming down materially. What will that do to you guys, your bond position? Will it push you further out the curve because you can't get those same safe high yields that you've been getting, or will you have a different strategy?
We wouldn't push further out on the curve, and we would be very hesitant to try to push into riskier asset classes. That was a position that we were put into during the late 2010s when you had 0% short-term rates.
Hmm.
But when you had that move higher in rates from 2021 to 22, I think that caught a lot of people offside. I don't think we're going back to 0% rates, but it is something that we need to be cognizant of. One way to think about this is right now, as far out in the curve as we can go and still get a 4% rate in the short term. So right now that gets you out about 18 months. That's usually about as far out as we're trying to go. If you saw a cut in the Fed funds rate, that's really not too big of a difference for us if it's 25 or 50 basis points. The long run average in our conservative fixed income strategy is about 3%. You're trying to stay a little bit ahead of inflation. So we want to make sure we're getting the best risk-free return we can get, but really avoiding any significant potential losses. So if we're still staying in that 3 to 4% range on the short end, it's not the worst thing. We would accept that. It would only be if they cut rates a huge amount and you saw a 1% Fed funds rate again that we'd have to rethink what do we want to do here.
Okay. So does that mean today is almost kind of like a Goldilocks moment for, or at least just a really nice moment for capital managers like you to be able to park liquidity into something that's yielding as much as it is with as much safety it is?
I think that's a great way to put it. And I think investors, I think, are on edge because of the potential for a shock or something to occur in the economy that could hurt one of these asset classes. And we're very cognizant of that. But as currently situated, you can get 4 to 5% return in the bond market, whether that's treasuries, a tax adjusted basis on municipal bonds or high quality corporate bonds. And then equities, we think they're a little bit overpriced, but we can find a high quality portfolio. We think we can get a decent return in that's lower beta without taking too much risk. And then the third piece we haven't touched on much this time is commodities. And we think that's been a good space to be for the last few years and continue to have an allocation to whether it's exposure to precious metals, energy, industrial metals, or agriculture. That's been a third leg to this balanced portfolio that we've liked having and continue to have.
Okay, yeah, and I think the last couple of times I've talked to Ted, he said, it's not so much the 60-40 anymore. If I remember correctly, it was the 30-30-30-10 allocation. Can you just very quickly tell people what's in each of those tranches?
Yeah, I think his version of that, and I don't think we try to stick exactly to those numbers, but I think the idea is just getting across that instead of thinking just in terms of stocks and bonds, that it's stocks and fixed income, but commodities as another layer that if you're allocating properly to high quality businesses with exposure to commodities, and it can range across a number of different areas. It doesn't have to all be oil or all be gold. That's a good additional way to diversify. And we might be in the middle of a multi-year period that could last a decade here where you start to see commodities start to outperform other asset classes. And we were talking earlier about these cyclical changes in markets, whether it's the equity allocation by households, and that's going to mean revert. Well, there hasn't been a mean reversion in decades for commodities versus stocks. And that could be something that ends up shifting back towards the long run average over the next 10 years.
All right, I'll try to find the latest chart from Tavi Costa that tracks the ratio of, I think it's the S&P to the commodity index, and I haven't seen it recently, but to my memory, it was plunging near all-time lows in recent years. I doubt it's picked up that much recently. So there's, if that does mean revert, to your point, there chance it's still got an awful long way to go. Now, of course, that could mean revert one of two ways. That the commodity complex really could catch fire here. And there's a lot of reasons to think that it could. One, just relative undervaluation, but also with the new administration, there's the drill baby drill, mine baby mine, commodities, outlook for commodities right now. And commodities have always been important geopolitically, but I think we have woken up both from COVID and then through this trade war that we're going through, that there are a lot of essential commodities that I think many countries are realizing they are overly dependent on other players out there that maybe aren't their favored partners, right? Great example for the U.S. would be China in the case of our rare earth products, our pharmaceuticals, et cetera, right? So there seems to be kind of a newfound scramble around the world to secure sources of commodities, and that would all put pricing pressure up. So, we can probably tell a pretty good story about, hey, bright future of demand for commodities. Of course, Rick Rule would add on top of that, we've just structurally underinvested in CapEx in the commodity complex, that even if we just have steady state demand going forward, we're going to enter some supply crunches just from the fact that we didn't invest enough in years past. So that's all kind of on the pro side. I guess on the con side is we could flip into some recession or see a big drop in demand economically, and basically commodity prices could catch down, and stock prices could catch down to commodities, where with commodities not really going up all that much. But anyway, sounds like you guys see enough optimism there that this is a place to play in.
We do think it's a place to play in. We're trying to be smart about the allocation that we have. And to your point about the potential downside, if there is a recession, commodities are going to get hit. These businesses would take a significant leg down. And what we do in that scenario is we monitor these positions very closely. And if anything that we own, whether it's in the high income portfolio or the long-term growth stock portfolio, is down 20% on our cost basis when it's first bought into the strategy, we'll assess, like, we either need to significantly increase this position if we really believe it's going to work, or more likely, this is different from what people were taught over decades, but the market's really smart. It could just be that you're wrong. And most of the time, your timing was wrong, or things played out differently than you anticipated, and it's okay. It happens. You just need to take the small loss and get out. And it actually helps you sort of reassess where things are at. So if you had a recession hit and some of these positions started to really turn against us in a significant way, we would be moving on them pretty quickly to either increase if we think this is something that people are overreacting to, or we would draw down our exposure a significant amount and wait for things to turn in the economic cycle before jumping back in for the next leg.
Okay. All right. And we talked earlier about the market, high level of market valuations. Now, obviously, this is a market that is being, you know, the preponderance of the action is being driven by a very small number of stocks, right? Which sort of distorts the averages, right? Um, so is the commodity complex as overvalued as the general stock market, or is it looking better on a relative valuation standpoint?
It's looking better right now. So if you're looking at energy, the free cash flow yields on those businesses are pretty solid. We're still happy with the prices that we own those at. In precious metals, you have seen a significant run up in price for a lot of those gold and silver miners. Although if the price of gold and silver stay where they are or in this range that they're at now, those valuations are going to compress and it's going to look pretty good. So it's almost more monitoring the movement in the underlying commodity price rather than the underlying stock price. And then in some of the other businesses we own, like in the agriculture space, it still looks like a pretty good valuation to own those and see if things can turn upward over the next several years. So we would say it's different than the expansion in valuations in those mega cap stocks and some of the major industries like in tech.
Okay. Meaning, probably a little safer to buy in because they're not quite as hot. Yeah, at least not yet.
Yeah.
All right. And one thing that drives, I mean, stocks in general, but commodity prices as well, is the dollar. And the dollar has been weakening a lot recently. A lot of discussion right now is, is that something that's going to need to mean revert? Meaning, is the dollar going to strengthen here at some point? If it does, what impact, if any, do you expect that to have to the commodities that you get or the commodity related investments that you guys are currently positioned in?
Usually the typical rule is if you saw strengthening in the US dollar, then that would be a problem for commodity prices in US dollar terms. And then the companies exposed to that could see a bit of a downturn. But it was interesting before this real significant weakness in the US dollar in 2025 relative to other currencies, when the dollar was very strong previous to that, you had the gold price holding in and going up from there as well, too. So in some of these cases, like you talked about with Rick Rule and the structural underinvestment in mining a lot of these commodities, that might be an even stronger fundamental driver than what you have in relation to movement in the currency. And then in the US dollar in general, it's just interesting. I think people are picking out specific points in time or charts. This has been the weakest start for the US dollar relative to other currencies in 50 years. It could continue. But if you look at a longer term chart, going back to cyclical versus secular, the US dollar relative to other currencies moves in a very cyclical fashion. And we're basically back to where we were 4 years ago in 2021. It's not as if it's a huge extreme in either direction if you looked at it on a longer term chart.
Okay. All right. Well, let me ask you a somewhat related question. So, we were talking about how the demand for gold is in part being driven by central banks, which are basically saying, "Hey, look, we'd rather own a little bit more gold than U.S. Treasuries." So it's to a certain extent, it's a monetary consideration that's driving this. Um, so gold had performed quite well, over the past 2 years. I mean, I think at the beginning of 2024, gold was like around 2,000 an ounce. The day we're talking here, it's somewhere around 3,350. So pretty substantial appreciation in just a year and a half, I guess. Silver took much longer time to start showing life, but it has of late, and it just broke out of it. It risen up to $35 an ounce, and had been ping ponging between 35 and 37. And really seems to have just recently broken above 37. A lot of people have said technically once it does that, it's highly likely to go off to the races. I'm looking at the gold silver ratio here. It is starting to really, mean revert, I guess. It had been much more in gold's favor, but it's starting to mean revert. How much more room do you think that silver may have to run if the gold price hangs out here?
Your point about the mean reversion, that was something we noticed too. And that was one of the reasons why we were adding to silver and some more silver exposure with miners in recent months was they move based off different characteristics, gold versus silver. Silver is used more industrially than gold is, but there is that connection. And when silver becomes so cheap relative to gold, it only happens once every several years. There does tend to be a reversion back towards the long run average. And so you don't know how far that move's going to go, but we weren't surprised that if gold's going to stay here, that silver is having this catch-up trade. And as we discussed earlier, it's had such a good run, gold and silver, that there could be a consolidation here, a little bit of a short-term correction. And Ted and I have talked about it. We're monitoring, especially our minor positions, if we need to take a little bit of our exposure off the table, but we're very mindful not to get too cute with it, that this is something that we've owned for several years. We think it's going to continue to be a good structural position to have for years to come. And so we're always mindful of how much risk we have at the current prices, but still like the long-term view for both commodities and the businesses attached to them.
Okay. And let me ask you this. What are you more likely to do at Oxbow as you manage your capital there? Let's say there's something that you're owning for a long-term hold because you've got a long-term thesis for it. But you think in the short term, it's had a good run, it might cool off, might pull it back a little bit. Will you trim the position and then add back later? Or will you keep the position and put a hedge on it?
We try to keep it as simple as possible. So we wouldn't try to do any sort of options hedging or things like that. I realize that can be effective for a lot of other types of investors. We would either think it's a strong enough reason to trim it and then could always add back to it in the future. Or if you want to just continue to hold and it might be choppy for the interim period, but still like it in the long run, that's typically what we do more in our stock portfolio, where the gains can really be outsized if you're right, and the winners continue to win for years to come. Trying to time that trim is really hard. And so you're better off just letting it run for as long as the fundamentals continue to come through for that business.
Okay. All right. Let me ask this question, which kind of bridges the monetary and the risk on, the monetary and the animal spirits. So on the day we're talking here, Chase, Bitcoin reached yet a new all-time high, was up again another several thousand points. It's down a little bit now at the moment we're talking here, but I think it hit a high of about 123,000 a coin. I think it's down to about 120 something right now. So obviously it's had an amazing run as well of late. And some may say, well, that's just Bitcoin, like gold, reflecting all the fiscal profligacy and the runaway debts of the major world economies. And there's probably some truth in that. But others see Bitcoin as sort of the poster child for risk on, right? And they just, there's others that are looking at it and saying, hey, this is just a sign that the market is just running red hot and probably, getting way ahead of itself. And Bitcoin does this and is likely to, crater at some point in time, as it does when it gets way too far ahead of its skis. I don't think you guys own Bitcoin at Oxbow, but correct me if I'm wrong on that. What's your interpretation? What is Bitcoin telling you guys?
We don't own Bitcoin and don't have a strong stance on crypto. We try to focus on owning things that have clear cash flows coming through. And the only outlier to that would be gold or silver, which has thousands of years of history to show that it's a prized currency by people worldwide. Bitcoin, we just view as too short of a history. It could continue to be a great allocation for people, but it's not something that we're going to throw into our clients' portfolios. They can decide to do that on their own outside of what they have with us. But we do monitor the characteristics that Bitcoin exhibits. And earlier in its history, its volatility was extremely high, almost similar to Cathie Wood's ARK fund. That was more of our proxy for it. And then more recently, in the last few years, we say it's moving a little bit more with the volatility of the triple Qs, which would be like the NASDAQ 100 ETF. and tends to move in a similar fashion where if inflation is accelerating, you're going to see tech and you're going to see Bitcoin go up. And that's the environment we think we're heading into in the second half of this year with inflation starting to move a bit higher. The big thing to know, though, is when you see growth and inflation start to decelerate at the same time, that's when you see both tech, but especially Bitcoin and the rest of crypto really fall off a cliff in price. And we saw it in the February to April swoon earlier this year. And it's something that we think if you want to play in that world, you just have to really understand the magnitude of the swings. And I would be paying really close attention to what's happening on those year over year economic growth and inflation rates. Because when you start to see both of those head downward, you need to get out because it can be a very sizable drop very quickly.
Okay. So, I mean, if we look at economic growth and we look at inflation, neither is taking off right now. Now, of course, markets forward looking, so maybe it's got a different outlook. But we had the negative print in Q1. Q2 looks like it's going to come in at two something, at least looking at the GDP now data here. Inflation, I know the Fed is still waiting to see what the impact is going to be from the tariffs. But current inflation rates, both from the Fed or from the BLS and from independent sources like Trueflation, still has it in the twos. It's not like it's running away here. So let me tie this to something you guys said in your recent letter. You said our total outlook remains the same. It appears that the next decade will be a trading decade. In our opinion, you'll need to take advantage of lower prices and let go of some current high price holdings. One of our proprietary indicators, which measures overall market direction, is flashing yellow or caution. So, you tell me, what do you think is more likely from here? Growth and inflation to the upside from here, or more sort of I don't want to necessarily use the word recession, but a bumpier, slower, more moribund economy.
Yeah, I think the best way to view it is just to compare across these different areas. So I think your point's right that we end up with, right now we're give or take about 2% real GDP growth in the US and inflation rates about 2.5%. It could trickle up to being about 3% inflation. So technically that's an acceleration, but it's not like when inflation went to 8% in
Right.
2022. It's a little bit more contained than that. We'll see what happens when tariffs really go into effect. If that hard deadline is August 1st, I've heard from businesses that you're really looking out in the next few months after that deadline hits to see what the impact's going to be and what that does to inflation and economic growth. But when we look at that, so say, pretty neutral, normal enough economic growth and inflation, and pretty neutral interest rate policy by all the developed market countries around the world. What's the one outlier from all this is you've got a stock valuation that's well above a neutral level. And I think that's the thing that we're paying the most close attention to. It doesn't have to revert to normal just because it's the outlier right now. But in the past, if you had a 4% short-term treasury rate, 4.5% 10-year treasury yield, you did not have stocks trading at a low 20s PE multiple. You'd be more in that mid to high teens level, which it's an easy 10, 20% drop just to get back to more of a normal position for stocks. And that's where we're trying to just be cognizant of what risks we're trying to take in our clients' portfolios and settle for that 4% risk-free rate when we're not seeing the opportunities we want.
Okay, so let's kind of end on positioning. So also in your letter, you say our advice has been to keep a reserve of liquidity because it will pay off when stock prices do correct. The reason we say it's a different time now is because the headwinds are many. We've talked about a number of them here. So presumably you guys, I think the last time I talked to Ted, like your stock portfolio had a historically high percentage of it sitting in T-bills because you were keeping some powder dry there. Sounds like you're still keeping dry powder. How active are you guys right now? Are you actually finding enough values out there to be creating new positions, selling out of other ones, or are you more kind of in a let's just keep our powder dry and wait and see mode?
Yeah, I mean, we're still active. We're still participating. We bought a new stock in our stock portfolio for clients today. So it's not that we're so bearish or so cautious that we don't want to do anything. What ends up happening is there'll be certain positions in the stock portfolio that need to be moved out because based off the rules that we've set, they trigger something that's usually an automatic sell for us. And we want to find something else that's a better fit for the portfolio in that circumstance. So even though we've got right now still about half of that stock strategy sitting in 3-month T-bills, the rest is still allocated in a manner that we think is a pretty smart fit for the current environment. There's a mix of some defensive sectors, like your consumer staples, healthcare, and utilities. But then what we've done in the cyclical sectors is we're trying to identify really high quality businesses with very consistent cash flow growth and visibility on what they're going to generate over the next several years, regardless of what's happening in the economy. They just happen to sit in cyclical sectors. So it's almost like a counter-cyclical bent within these areas that people might be taking on more beta, more risk. We think there might be a time for that when the valuations present themselves, but this is the way for us to get exposure. And across that portfolio, we own stocks across 30 different industries that are all moving based off different characteristics, but in a manner that fits what we want with the level of stability that we're trying to achieve.
Okay. All right. Well, look, as we start to wrap things up here, Chance, what's the question that I didn't think to ask here that I should have in terms of anything else that's burning brightly on your guys' minds there at Oxbow today?
Probably the thing, I mean, we touched on it a little bit, but it was a good point you made is really thinking about rebalancing and thinking about where you currently sit in your portfolios. For anybody watching, just given the gains I imagine you've achieved in your stock portfolios, and then what do you really need going forward? Because we think now is a decent time to be able to switch to a more balanced look, especially with treasury yields where they are, the opportunity in commodities. And when we think that's as good a time as any to try and have a little bit more of a balanced fit rather than continuing to have 70 or 80% sitting in stocks, especially if you're at a point in your life where you don't have a high amount of income coming through the door.
Yeah. Okay. Great point. And just to reiterate something I've been saying in discussion a fair amount recently with other experts like you, Chances, investors tend to think of at least retail investors tend to sort of think of investing as an all or nothing, right? I've got to be all in it or I've got to be all out of it. And rebalancing is exactly the opposite of that. It's just saying, hey, look, you can just be a little less in it or a little more in it, depending upon the market environment. And to your point, this is a time in the market where things have run really hot. Many people are sitting on gains that are better than what they were expecting just a few months ago. Don't have to sell out of the whole position, but takes at least some off the table and realize those gains, meaning make sure you get them. Because what people oftentimes will do is hold on too long when they stay in the casino for too long, and then the gains evaporate, and then they're sitting there kicking themselves. They didn't take advantage when they could. And it's a really good time to do that because you can then put those proceeds into a high yielding but much safer asset, right? It's kind of almost like I'm guessing the market universe doesn't give you this option, this type of option all that often in life.
Absolutely. I mean, I think you talked in one of your recent interviews about recency bias, and I think that's absolutely right. You look back the last 15 years, most of that time you could get zero interest on a short-term treasury. And maybe people are still kind of in that mindset, not realizing that now you can get 4%. And that's a pretty nice place to be as a backdrop rather than feeling like you got to have most of it in riskier stocks that at any given time could go down 20% in a month, which we've seen happen several times just in the last 5 years. And if someone's younger and can handle that volatility and know they're going to rise out of it, that's great. But if you're in a different stage of your life and a 20, 30, or 50% drop is something that'd be really hard to bounce back from, then maybe that tells you rebalancing is a good thing to do.
Good thing to do. And just to add on to that, who knows, in 1 to 2 years' time, you may not get nearly as good of a deal if you've had a run up in a position, right? And if you're looking to park that somewhere safe, maybe you're only getting 3% or 2% or whatever, right?
Yeah, yeah, absolutely.
Yeah, and it does look like the Fed probably is going to be cutting at some point. All right, well, look, Chance, it's always great to have you on here. such a big fan of you and Ted and the team there at Oxbow. I did mention earlier briefly the book that Ted had written. Folks, if you'd like to get yourself a free copy of that book, the Oxbow folks are super generous and they mail copies out to anybody who requests one. So you can go request one over at thoughtfulmoney.com/TEDbook. And I'll put that link up on the screen when I edit this, Chance. Also, you guys at Oxbow, as I mentioned, are a high net worth client firm. So if you're watching this and you would like to talk to the folks at Oxbow, maybe get their advice on your own personal situation, maybe some advice on, positions that you're thinking about rebalancing, I'm sure, correct me if I'm wrong, Chance, but I'm sure you'd be happy to give, your general consultation to folks in terms of, how much you think they should trim back given their personal situation. You can request one of those free consultations by going to thoughtfulmoney.com/Oxbow. I'll have that link below the video here as well. I just want to make sure I'm managing everybody's expectations here because you're a high net worth firm. It really, if you have, $1 million or more in client assets, it works for you guys. If not, I just don't want to set anybody up for disappointment, but that's about the right threshold, right, Chance?
Yeah, that works. And I think, we're always happy to have a conversation. We're excited to be able to talk to people and hear what your situation's like, how you're doing. But yeah, it's just the nature of the business.
Okay, great. And just a reminder, folks, if you fit that criteria, it's thoughtfulmoney.com/Oxbow. Form only takes you a couple seconds to fill out. These consultations are totally free. All right. Well, look, folks, if you have enjoyed having Chance on as much as I have, please let him know that by hitting the like button, then clicking on the subscribe button below. Just a reminder too, please do hit that subscribe button. We're trying to get to 150,000 subscribers on this channel by the end of July, which is my birthday. And not only would that be a nice way to celebrate my birthday, but also if you do subscribe, you'll get alerted every time we publish a new video on this channel. So you'll get some benefit, but also YouTube gives this channel more love given having more active subscribers. And so if you want to help this channel just get out there and influence and help other people in the world, just taking a second to click that subscribe button really helps. All right, Chance, it's always a pleasure to interview you. Best of luck to you, your wife and your boy, and the whole team there at Oxbow. I'd like to give you the last word. Any parting bits of advice for folks that are trying to navigate this current market environment, whether they're nervous about the same things that you shared or whether they've got FOMO and are thinking, you know what, everybody's playing it too safe. And, my idiot brother-in-law is making money hand over fist right now. I got to get in.
It's been interesting. A lot of us in the office here have said that the first 6 months of this year, there's been so much news, both economic and financial happening, despite things being up 5% year to date. But it feels like a year or two has happened in just 6 months. And I think it's easy to get caught in the short-term news cycle. But the more you can think further out, think out 5, 7, 10 years, are you allocated the way that you think is best over that longer-term time horizon? That's a good starting point. And then, as Adam mentioned, think incrementally based off of that current allocation for the long run, so that if you get a big drop like we had in April, it can happen very fast, but then you can adjust incrementally to take advantage and then adjust incrementally again when we're back at the highs like we are today. That's the way that we like to think about things, but it all starts from that 5 to 10 year framework rather than what's going to be the next monthly data point that is going to adjust the Fed funds rate by 10 basis points.
Very well said. All right, Chance, thanks so much, my friend. Look forward to having you back on next quarter.
All right, thanks, Adam.
All right, and everybody else, thanks so much for watching.
We like to provide the information we think is most valuable to investors. If you'd like to see more of our insights, please subscribe to our YouTube channel.